Most people have heard about the 100% bonus depreciation that was included in the One Big Beautiful Bill, but there's a critical detail that almost everyone is overlooking, even the experts. In this video, I'll reveal the little-known requirement from this new tax bill that can dramatically impact your 2025 tax planning. Let's start with an overview of bonus depreciation. The last time that we had 100% bonus depreciation was for the 2022 tax year. Since then, it has phased down by 20% each year. For 2023, it was 80%. For 2024, it was 60%. And for 2025, before this new tax bill passed, it was going to be 40%. However, with the new tax bill, assets that qualify in 2025 can now receive 100% bonus depreciation again. And this is huge for a lot of industries, especially the real estate industry. Typically, you're able to take bonus depreciation once an asset is placed in service. And we really haven't needed to pay attention to much more prior to this new tax law. However, here's the thing that they aren't telling you, and that is that the new law requires, in order to receive 100% bonus depreciation, that an asset is both acquired and placed in service after January 19th, 2025. The placed in service date is sometimes easy to determine because that is usually when you have an asset that is available for you to use. In the case of real estate, that's typically when you are able to rent it out. It means that it is in rentable condition, you are advertising, and someone could move into that property even if you don't currently have a tenant occupying the premises. For machinery or things like that, it's typically once you start actually using the equipment in your business. The acquired piece is a little harder and will catch a lot of people this year. Acquired means not necessarily when you actually purchase the asset, like the transaction was completed, but it is actually subject to what is called the binding contract rules, which is not something new. It's just that it hasn't mattered since we were at something lower than 100% bonus and then went up to 100% bonus. And the last time that occurred was in 2017. Since then, we haven't had to pay much attention to it. The binding contract rules basically say that if you had a binding contract, that is the date you're treated as having acquired the property. So as an example, you could be under contract for something prior to January 19th. Say you were under contract at the end of December, but you hadn't actually received the asset, whether it's a rental property you were buying, a piece of equipment you had on order and put a deposit down on, but then you received it after January 19th and started either placing that equipment in service, or you closed on the rental property and started renting it out. A lot of people think that will definitely qualify for 100% bonus because I didn't place it in service until after January 19th. However, if it's deemed that was a binding contract, you will have been treated as acquiring that asset prior to that date, and you may only be eligible for 40% bonus depreciation, which was the previous law in place. So the question becomes, what is a binding contract? There are de minimis exceptions. So if you didn't have to put any money down or it wasn't enforceable by law, then it may not be considered a binding contract, but it's typically considered binding once you essentially can't back out or there's some big risk of forfeiture. So you definitely want to look at that if you had any type of contract on any assets prior to that January 19th, 2025 date. The other part that this comes into play is with constructed property. The code separates out purchased property versus constructed property. Purchased property is subject to the binding contract rules that we just covered. However, constructed property, which typically would be real estate that you're developing or have contracted out to build, it could also include specialized equipment. If it's constructed property, then the determination of when property was acquired is when work of a significant nature begins. And so this typically will not include the planning phase if you're doing zoning or initial plans, but it would include once you actually start moving dirt, laying foundations, things like that in the case of real estate. So if you had a project where work of a significant nature began before January 19th, 2025, even though you completed it after that date, maybe even in 2026, it wouldn't be eligible for the 100% bonus depreciation rules. However, there is always an exception. The regulations do allow you to make an election where you look at the individual components. If you started work prior to January 19th, 2025, you would look at what was completed prior to that date and the components of that building, and you would take only 40% bonus if it was eligible for bonus depreciation on those assets. Any of the work completed after January 19th, 2025, you would look at those components, and if they're eligible for bonus, then you could take 100% bonus on those. This is really important when it comes to cost segregation studies, which essentially look at the different components of a building when trying to figure out the depreciable life of those assets, and it allows you to accelerate those depreciation deductions. When you get a cost segregation study, there may be some assets that qualify for 40% bonus and others that qualify for 100% bonus. I would encourage you to bring this up with your advisors and so-called tax strategists to see if they have considered this or looked into it, because so far there is very few cost segregation companies or other advisors that are aware this is a consideration. If you have any asset acquisitions where this is questionable, start looking at this now and planning ahead so you can be proactive before the end of the year if there's something you need to do in order to implement your tax strategies.